So, welcome again. And what we're going to be covering today is a couple things. Basically, a little bit about reverse mortgage, a little bit about how reverse mortgage purchase is helping realtors to generate more business. So, we've been in the industry for many years. I've been doing reverse mortgages for about 13 years now. And what I've found, especially over about the last 8 years, is that there are more and more older homeowners that are looking to sell, maybe not because they want to, but because they have to. And many of them end up using a reverse purchase loan to buy their next home, which is different than a refinance to stay in the home. So that's what we're gonna do today. We're gonna jump in and we're gonna learn about those things. We're also going to, of course, at the end of the presentation, have some tools that actually will help you to get to those listings. So I just don't want to unload a bunch of information on you guys and then think that it'll turn into a listing. We want to take it to the next level and actually provide the tools that will help you turn this knowledge into a listing without doing much more than what you're just doing now. I think we really want our information to be just addition to what you're already doing and have it bring you more business without having to start some kind of whole new thought process or marketing plan. That's not what we're about. We're about enhancing what you're already doing, okay? So let's get started here. So you guys should see the PowerPoint. We're gonna talk about what a reverse mortgage is. Sure. We're gonna talk about, oops, as soon as I can get the machine back to working. We're gonna talk about what the difference is between the refinance and the purchase. We are going to talk about the outlook. Are these things for real? How long have they been around? Will they continue to be around? Why? We're going to talk the difference between what's really going on in our industry versus what do we hear. Two different things. So we want to cut through cut to the chase, find out if this thing is real, if it's helpful, or what the downside might be as well. If somebody wants to buy a home using a regular loan, well, no matter how old they are, basically almost no matter what they're buying, traditionally you put down 20% for conventional type financing, you're putting down 3.5% for FHA style financing. Our loan is totally different. Our loan, the down payment is dependent on the age of the client and also the purchase price of the property. So we have a calculator to help you do that, but we'll also show you why and how the calculator does that. And finally, I want you guys to be able to use this information to help clients to be value added. For clients to say, hey, that information they gave me was great. Who was that agent? That agent was really helpful. And ultimately, for them to list their home, we can do the reverse purchase, you do the real estate, and that equals a transaction for you. So that's where we want to end up. And there are many times that somebody should not refinance and stay in their home. Most of the TV commercials that you see are generated, or things you see advertised, are generated to try to get people to refinance and stay in their homes. When many times they should not. They should not refinance the reverse and stay in their home. Sometimes they should sell and repurchase. It's more efficient. I'll explain why that is. All right, let's just talk about the loan. First of all, what it is. Hey, reverse mortgage is just a mortgage, you guys. It isn't like a totally different product. And I think that's where I've seen in my last 14 years, a lot of people separate it and want to say that reverse is something totally different, etc. I just want you guys to think about it this way. A reverse mortgage is just an FHA loan with an optional mortgage payment. In other words, if you got a reverse mortgage, okay, and 1 month you decided, I don't want to make a payment this month, or maybe 6 months in a row, you didn't want to make a payment, you can just stop making payments. Well, how does that work? Well, if you don't pay interest that's due on a loan, and this is really any kind of loan, not just a reverse mortgage, if you don't pay interest on something, it adds on to what you owe. That's how we handle it. If you get one of our reverse loans and you decide to stop making payments, we'll just add the interest on to the balance. That's it. You've reversed it. But you can go the other way. You can start making payments on it. You can do whatever you want. The point is that it's undefined as to how you want to use this loan because it's your choice. So it's been advertised as never make a monthly mortgage payment again. So why do we talk about making a payment when it's maybe advertise and not make payments? Because we want everybody to know you have a choice on how you can have your loan run. Maybe you don't want to have a bunch of interest add on to your loan and have the balance going up, right? I think that's a scary part of a reverse. Is somebody might say, man, I got this loan 10 years ago, my balance has gone up so much. And that is not very exciting. Well, maybe that person could have afforded to send in maybe half a payment a month. And that would have made a huge difference in how much they owed in the future, but also would have given them the freedom to not be stuck making that payment if they couldn't. Okay, so what's a reverse mortgage? Throw everything away that maybe you thought you'd heard or might be different, and just think of it as this. It's a loan with an optional payment. And if you decide to never make a payment again, that's okay, because it's built to protect you. In other words, you don't have to worry if you decide never to make a payment again. Because the protection in this loan is that if you say, I'm never going to make a payment to you, bank, you can still live there the rest of your life. And they will just add on the interest every month. And when you decide to sell the home, or maybe when you pass away, then they'll look at how many payments you didn't make and the interest that was charged and say, here's what's owed. Just the system of keeping track of what's owed and what payments you've made. But the important part is that they can't come to you and say, hey, you know, you've not made payments for 5, 10 years and the balance has gone up too high compared to your value. They can't do that. They can't come and say, we need you to start making a payment. They have to stick to their original deal. Was if you don't send anything in, that's their worry. They have to wait. How does this work? I get clients that say, Ryan, why would a bank or an investor do a loan? How can they afford to loan money and not get paid? Well, they will get paid. It's just they got to wait for however long you have that loan for, the client has the loan for, to get paid back. So they literally are sitting there just watching the interest add on going, man, one day we'll get paid on this. We just don't know when. And they sit and they wait. And that's how they do it. And these are really big institutions that hold these reverse mortgages because they have to be able to wait to get paid. So these are huge firms that ultimately end up owning these loans. Maybe a pension plan might buy a pool of reverse mortgage. Maybe an insurance company, huge companies. So that's how it works. So one of the defining moments for me in my career doing these loans was when we could turn this into a purchase loan. And by the way, I don't know if Crystal mentioned, but we do answer a lot of questions as we move through material. We will take a break in a bit to answer some, but hang tight because we will get to them, but I might answer them. So like I said, there was a big thing that happened in 2009. That was this. I have friends that are realtors. I know realtors, etc. A lot of them out there talking to homeowners, and they would run across homeowners who were in difficult situations. They were maybe about to lose their home. They couldn't afford the payments. They needed to get some cash out because they wanted to do some work on the house. But at the end of the day, they had a problem. And a lot of them, their only solution might have been to sell the home, which as a realtor, great. I get a listing because these people really need to sell. Well, lo and behold, here comes the commercial on TV. Hey, if you're having a hard time and you don't want to make payments, we'll make sure you stay in the house the rest of your life. You don't got to make payments, etc. And whew, there goes a listing, right? And a lot of agents would bring me a client, say, Ryan, this client's having a hard time. They saw a reverse mortgage commercial. I guess you could help them because I'm not going to get any business out of it. And so I would say, yeah, you know, there's no loan out there that can help them except a refinance reverse, right? Where they have to stay in the home. Because prior to 2009, I did not have a purchase reverse. So when the purchase came out and an agent said, Ryan, I have a client, they're having a hard time staying in their house or they need to move, but there's no loans available except that refinance. I said, hold on. I do have a reverse purchase loan now, which means that if they're having a hard time and they need to move, I can use a reverse purchase loan to help them get to their next home, and all the same rules apply. They don't have to make payments if they don't want to. They can stay in the home without worrying about being foreclosed on. They can make a half a payment. They can decide what they want to do. So that was a big deal, right? And the reason why my loan is a big deal in these situations is I do loans a lot of times when they can't get any other loan, okay? So that's important for the purchase loan, right? because that's what makes these people portable and able to list their home. Because they might never qualify for any other type of conventional financing to buy a home, so they think they have to stay in their home. They've been turned down by banks. Their credit score is bad. They only got Social Security income. They got all these issues that would never get them a regular loan. And then lo and behold, we have this reverse purchase. And I say, you know what? I don't really care what your FICO score is. I don't care that you had a foreclosure. I don't care that you only got Social Security income. I can get you a loan done. And for a retired homeowner, this is a big, big deal. So I joke around a lot, and I say to some people when they come in or when they call or an agent refers them, and they're like, Ryan, I think I want a reverse mortgage, a reverse purchase loan. I'm like, really? Like, you want a loan where your balance goes up maybe and you've heard some bad things about it? That's the loan you want? And they're like, are you serious? And I'm like, well, maybe it's not the reverse necessarily that you want. What you're looking for is a loan that you can qualify for to buy a home where you couldn't qualify for another loan. Maybe that's more what you're looking for. Yeah, that's really what I'm looking for, is a loan that I can actually get. And the reverse happens to be it. Maybe I'm not excited about it. Maybe I've heard some scary things about it. But yeah, basically I need a loan that I can qualify for. And I say, well, good. I said, well, let me put you at ease and just let you know. Now not only do you qualify for a purchase loan, but you have an optional payment feature on this loan. You don't have to call it a reverse mortgage. As a matter of fact, the government doesn't even call these loans a reverse mortgage. Our industry does that. The government calls their reverse mortgage a home equity conversion mortgage, HECM for short, HECM. They didn't call it a reverse. They call it a home equity conversion mortgage, which means that it's just a mortgage you can make a payment on. That's it. So now what we have here, guys, is we have a tool, right? We have a tool that will help an older homeowner. Some of them will still refinance, and you're not going to get all of them. But for many of them, what this now allows them to do is be able to list that home with you and know they have financing they can get to buy their next home, because it's a loan they can never get within any other place. And then when they buy that next home, guess what? If they want to make a half a payment on the mortgage, they can. If they want to make a full payment 1 month, no payment the next month, they have that flexibility, which I think is very important in retirement. Heck, myself, sometimes I wish I had that flexibility. I love to be able to take 2 months off and maybe do a repair, do something to the house that I otherwise don't want to use other money for. That's how we should be talking about this loan. And that's how I want you guys to understand it works. Now, over the last, since 2009, right, doing these reverse purchase loans and working with realtors, there's one thing I've definitely learned. A lot of clients that end up using this product, they had no intention of ever selling their house. As a matter of fact, a lot of them just straight said, I don't want to sell my house. But what we end up finding out is that even though these clients don't want to sell their home, sometimes they have to. You see, as a nation, if you want to say, our retired homeowners are underfunded in their retirement. And basically, even working individuals are underfunded in their retirements right now. But when you've gotten to your 60s and you're retired, the chances of pumping up that retirement getting a little tougher to do. And so what we see is that the lack of savings or additional income when they retire means that that equity in the home is really what they need to use for housing and also to give them some extra money. That's why a lot of them call reverse mortgage companies. When they see that ad on TV, whoever the star might be, heck, we've even had celebrities for our company, and they would call in and say, I saw your commercial, I want to refinance the reverse. I want to stay in my house. Well, ultimately, because of the way our loan is, you have to have a certain amount of equity to qualify for a refinance. And that amount you have to have is different for every age. So when they would call in, if they didn't fit the right parameters, I would say, you know, even though you have equity in your house, you don't qualify for a refinance. And they would say, well, what else could I do? I'd say, well, if you don't qualify for a reverse, there's probably no loan you're going to qualify for. And they say, well, geez, Ryan, what are my options? I'd say, well, there is one option. And that option is you can still own a home and not have a mortgage payment. It just is going to be a different home than the home you're in. Well, of course, the initial response to that is some fear. Oh my gosh, I don't want to have to leave my house. And what I found through the years is that's more about the unknown of like what's going to happen, as opposed to them really not wanting to sell the house. It's just, where am I going to go, right? So after I explain to them and show them, look, you can do a reverse purchase loan. You can get into a different house. It's going to be a lower priced house because that's how the loan is going to qualify, but you can still own a home with an optional mortgage payment. So that is the beginning of somebody who really doesn't have any intentions of selling their home. But after you run through their budget several times with them, you look how much money they need to spend every month, what they have coming in, it becomes very apparent that they're going to sell that house even when they don't want to. But at least we have a product that's going to get them something suitable to replace it. At least we have a way of helping them so that it's just not them selling and having to worry about buying something cash or going to a property that's way less or farther away than what they wanted to. So that's how this thing loan will help turn people into listings for you guys. It makes before what might have been impossible possible. And we're going to go through more of that coming up. All right, as soon as I get to the last bullet points, we will jump on some questions. Okay. If a client can refinance, and this is just for you guys to really kind of understand the loan. Sometime a client may end up refinancing. I just want you guys to have good information because ultimately they might end up selling anyways. So at least you can have a little bit of knowledge on the refinance. When somebody refinances a house with a reverse mortgage, again, it's just like refinancing a regular loan, right, guys? I just want you guys to think of this as a loan with optional payments. So if you can refinance a house with a regular loan, you can refinance a house with the reverse. When clients refinance or when clients get qualified for a reverse mortgage, whether it's a purchase or a refinance, we're going to figure out how much they can borrow based on their age and the value of the property. And, well, interest rates play a small part too. So if a client ends up refinancing and I say, oh, you're 70 years old and your house is worth $700,000, maybe you qualify, and these are very round figures. Maybe you qualify for a $350,000 loan. And they say, oh, okay, well, I owe $200,000 on my current mortgage. Oh, okay. Well, the first thing we have to do is clear that title. So we'll pay off the 200 and now you have 150 left. How would you like that 150,000? And the clients can choose a mix. They can say, oh, you know, I'd like to get big lump sums, and we can help them get large sums. Maybe they say, you know what, how about how long can you give me $500 a month for? And we will calculate that. So in other words, you can refinance a house and get cash out, and there's multiple ways to do it. And how you qualify for either a purchase or a refinance reverse, how much money you're going to get, again, is based on age and the value of the property or the purchase price. So that's how we know. Formula. You don't qualify based on your ratio of income. You don't qualify for a lot of other ways that regular loans qualify you. We qualify based on age and value. Those are the two main qualifiers. Now, you can buy condos, single families. Hey, a 1 to 4 unit is considered a single family for us. So at the end of the day, again, much like a regular loan, buying the same type of properties. Now, you can't make this a rental property loan. In other words, you can't do a reverse on a house and then leave it permanently and rent it out. It's got to be owner occupied. You can certainly live in one room of the house and rent out 2 other rooms. That's fine. You can buy a 1 to 4 unit and rent out the units. That's fine, as long as you're living in one of the units. That's where the catch is. Make sure someplace in that house is yours, then that's where you're returning to. You know, we always say 51% of the time that you're out and about in terms of where you're living should be in that property, but you can go stay other places. You can have second homes, you can travel, you can do whatever you want to do. All right, I think that will do it for that slide. So Crystal, do we have any questions?
Yes, we do, Ryan. All right, so the first question we have is from Connie, and she says, what happens when the mortgage amount surpasses the market value of the home?
Okay, so again, this is one of the fundamental protections that are built into a reverse mortgage. We never look to see how much is owed versus value after you have the loan. We don't ever send you something that says you're in an upside down situation. Now, when the house is eventually sold, right, it's a non-recourse loan, which means that the house is really upside down and the heirs have inherited, or you're selling it, you're not going to be responsible for paying that deficit. It's a non-recourse loan. And we're going to go through more in a couple slides ahead on what exactly happens at the end of the loan with the heirs, or if the house is upside down or has equity. But to answer the basic question there, we're not going to send you something that says you've exceeded some type of limit. Your balance has gotten too high. That's the risk that the financial institutions who are holding these loans are taking. They're saying we are taking that risk. So that's good to know. Now, you may hear about people that have gotten foreclosed on with the reverse, but that's for other reasons. And we'll talk about those coming up. But it has nothing to do with that they've not made a payment for 20 years or that they owe too much. Doesn't happen for that reason.
All right, thanks, Ryan. And I think the second question we had from Dorothy kind of encompasses around the same area. So they asked, when you say a senior can stay at their home for the rest of their life, can the loan plus all the unpaid interest go over the value of the house? And if that person dies, will the proceeds of the sales, which may be below what is owed, settle the reverse mortgage in full?
Long question. I believe the answer to your question I did answer, but I'll run through it real quick and then we'll run through it again later on. When you have a balance that's higher than what the value of the home is, and the home sells where there's no equity there, so nobody's getting anything, but yet the bank's not going for a deficiency judgment or is not holding anybody hostage to paying down that upside down part. They're just saying, okay, that was the deal. We're gonna have to take a loss. If the property value exceeds what the loan amount is, then of course it handles much like a regular sale. The heirs, of course, can be in line to receive those funds.
All right, thank you, Ryan. And just want to remind everyone, if you guys want to enter our Amazon gift card giveaway, and we're doing 2 Amazon gift cards, one at 11 o'clock and one at 12 o'clock. So you don't have to just have a question to put your name and email in the chat. Just even if you don't have a question, just go ahead and, you know, put your name and your email in the chat. Thank you. I just see somebody enter the giveaway. So don't want you guys to miss this opportunity, but it looks like we just had 2 more questions if we can answer them really quick. So
Sure.
Monica asked, can you purchase a home first while having the existing one and sell later?
Okay, I think I know what she's asking. So if you want to purchase a home, you can keep your current home. You don't have to sell the home to buy the next home. Remember, whatever home you're going to live in, that's where we want the reverse mortgage to be on. So if you're going to purchase a house in the reverse, you have to move to that house. But we don't really care that you keep the other house. You just need to have the down payment. Okay. If you own a home and you have a reverse currently and you want to buy another house using another reverse, well, you can't have 2 reverses at the same time. So that's when you would have to either refinance that house to pay off the reverse or sell it. So then you could do the reverse purchase. So we remember we're reverse purchasing, we're using the loan as purchase money, and it has to be owner occupied. So you end up living in that home.
All right, perfect, Ryan. And last question from Rosie. She asked, if the person has other property as investment property and bring him/her income, will he or she qualify for this type of mortgage? So I'm assuming she's asking, can you have rental income as, you know, to qualify for this loan?
So our qualifying for income is just completely unlike any other type of loan. And oftentimes it's much less than what you need to qualify with. So most of the time we have Social Security helping people qualify, and that's about it. If you are in the situation where you do need a little more income and you do have rental properties, we can use that rental income. Of course, the rental income has to be on your tax returns. So very rarely are we dipping into tax returns to help people qualify. Usually we are finding other ways to qualify, which the main source of our income, Social Security.
All right, great. Just one quick question. Nina had just asked, is the interest rate comparable to conventional loans?
Yeah, and it's pretty comparable, a little bit higher. For instance, if you took a fixed rate reverse, you could probably get, you can get anywhere between 3.5% to 4% right now. If you're taking an annual adjustable, your rate is in the twos, 2.75, 2.9. So very comparable. You are going to find the rate is a little bit higher. And a lot of people say, well, Ryan, why is it higher? Well, remember going back to how these investors who end up holding these loans, what they have to do. They're not getting paid sometimes for 10 years. They're waiting, right? Because if you're not sending a payment in, they're not getting their interest money. So they have to wait a long time, which means that it's a little risky for them, and they're also waiting to get paid. So they need to have a little higher rate to make up for what they're losing and not having that payment come in every month, right? So you typically will see a little higher rate on a reverse. And that's one of the reasons why, is that it simply would be less profitable for them if they did not have a higher rate and had to wait 20 years to get paid. It's a long time for an investment firm to not receive interest on the loan.
All right, great. Well, we're just getting questions. Well, we can definitely answer them. So Angel asked, what are the loan fees?
Okay, so let's address that question, by the way. Here's what I want to do. We have two different, or three or four, there's more than one reverse mortgage product out there, and they have all kinds of different fees. The main one that we're talking about here today, again, is the government-insured reverse mortgage called a HECM, or Home Equity Conversion Mortgage. You have what they call private reverse mortgages out there that are not insured by the government. And there's a lot of sales stuff going on right there, where a lot of companies who are selling non-FHA reverse mortgages will say, oh, these loans, they don't have the FHA mortgage insurance, or they're cheaper. But you know how that goes. It's always something with one loan or the other. So let's do a quick review of costs. When you're getting an FHA insured reverse, if you guys are familiar with any type of FHA mortgage, they come with upfront mortgage insurance and an annual mortgage insurance. So your standard regular home loan that's insured by FHA, they have a 1.75% cost of the loan amount. And then they have a 0.85% annual they charge on the loan amount. For our loan, you have a 2% upfront of the purchase price for the initial mortgage insurance, and you have a 0.5% annual. Now that's all rolled into the loan. You're not really paying that cash out of your pocket. In terms of other costs, it's much like a regular loan. You have your title and escrow fees, and sometimes there is origination fees depending on how you're setting up your reverse mortgage. So our costs are really a lot like your normal FHA loans. There isn't like some type of special reverse mortgage fee you're paying. It's much like your standard FHA loan in terms of costs. Your private reverse mortgages, they don't have mortgage insurance. So that sounds nice because you're saving an upfront fee. However, those loans typically carry a higher interest rate. So even if you're saving up front by taking a non-government loan, you may be paying for it in the long term by having a higher interest rate. And also those companies tend to be more conservative, and they lend less money until you start getting into homes that are like 900,000 and above. Then that's when those start to make sense because you can get more money than you could on the FHA reverse.
Okay, all right. Thank you, Ryan. So let's see here. Scott, wait, no, not Scott. Monica here had asked, are there any prepayment penalties now? That goes in line with the first bullet point that we talked about, right?
Exactly. One of the reasons why this loan is very flexible, and you can make payments. You can make a $50,000 payment if you got inheritance. You could pay the whole thing off in a year. There's no prepayment penalties. So in other words, nobody can tell a client what to do with this loan. If they want to make a payment, a prepayment, or refinance after a year, or start making payments, they can do whatever they want. And that's where the power lies. As a matter of fact, there really isn't a guide that's produced by the investors saying, hey, you can make a payment on a reverse every month if you want, or you could not make a payment, or you could refinance it. They don't have a good set of instructions with these loans. Instead, what they do is they have a box, of course, that's checked on the loan docs that says there's no prepayment penalties. So that's kind of the summary. If there's no prepayment penalties, you're free to do as you wish.
All right, thank you, Ryan. I see Peggy, you've asked, can we get access to this recording to review again? Now, this recording is being recorded by Arcadia Association of Realtors. So I believe that you guys will get the access to this recording, but just to make sure, you guys can go ahead and email Stephanie after the class to make sure that you guys get the recording for this webinar. All right, Ryan, I think we'll move on to the examples now.
All right, let's keep rolling on. Let's go through an example here, okay? And so most of the transactions we're doing are individuals downsizing, okay? And these figures here, by the way, are very general. And the reason I want to say that is you'd be surprised sometimes ends up doing reverse purchase loans. There's a lot of people living in LA, maybe even where you guys are at, Arcadia, you know, a lot of places with homes that are 1 to 2 million, and you wouldn't believe it, but they're barely making it by. They bought these homes a long time ago, and they're living off of Social Security income and maybe something else, and they're living in a big house that's now become expensive. A lot of individuals are overextended in their homes. In other words, while they were working, they qualified for a $900,000 loan. When they retired, not so much income. So even though we're going to go through an example, I don't want this to limit your thought process into terms of who might need this. About 6 months ago, over half of the loans I was funding were reverse purchase loans, and there were people selling $1 to $2 million properties that were strapped for cash. Who would have thought? I guess we spend what we make at all levels. I don't know. That's what I hear. I spend what I make. Whew. Okay, so let's run through this example. Let's say we find a client, 73 years old. We put 73 up there because remember, we need to know the age to understand what purchase or what kind of loan they're going to get, how much money they're going to get. So they live in a house that's worth $850. That's garden variety today out there. And maybe they need to move. Why? Well, maybe they don't want to move. That's where we're going to help you guys later figure that out. But it comes to the point that they have to move. You sell their $850 house, they had a pretty sizable loan on this. And when they sold, they had to pay off a loan. Maybe that's why they had to move, because that payment was getting too much for them. And they got $400,000 cash after all the costs and paying off their loan. So now you have an individual, they lived in an $850 house, they have $400,000, and what are we going to do? Well, we could do a lot of things. You could try to find them a $400,000 cash house to buy. Maybe not going to work out for them. Maybe they need to keep some cash in the bank, right? But maybe we can find something 500 or maybe even 600.
Okay, well, that's why I'm already doing it.
Hi, Gina. Could you mute your mic, please?
Oh, sorry.
No problem. You're good. You got to work.
Sorry.
All right. That's okay. All right. So when they've sold their house, and now maybe you find a replacement home. In this case, we just said 500, but it doesn't have to be 500. But let's say that they did find a replacement property for 500, and we want to know what they can do at 73 years old. Well, I would say, well, at 73 years old, you have to put down maybe about 255. Now, these numbers are estimated, and they're actually estimated a little high. This client actually nowadays might have to only put down 245. But for this instance, let's say they put down 255. The purchase price is 500. I'm giving them a loan for 245, which means that from the 400,000 cash they had from the sale of their house, they get to keep 145 cash. We've given them a loan for 245, which gets them into the $500,000 property. What's the benefit to them? Well, other than having money in the bank now, what have they done? They've made a mortgage payment optional, right? They've turned what was a mortgage payment they had to make, they had no money possibly in the bank, to having a 145 amount in the bank and optional payments. That is a complete life changer, total life changer. And if they're the type of individual that says, Ryan, I really don't want to see my mortgage balance go up a bunch, that kind of scares me, but this is the only loan I could get, I'd be like, cool. Well, your payment on that 245 loan might be, $1,600 or $1,500 a month. Why not send in $700? That way you're only adding half the interest on every month. That way you'll maintain a lot of equity in the future. And they're like, hey, that sounds pretty good. And then if something bad happens to you, stop paying altogether. Hey, that's a good plan. This person might have a 500 FICO score, and I still gave them a $245,000 loan. They might only have $1,800 a month in Social Security. Perfect. That's more money than I probably need. What's the idea here, folks? I think you guys get it. Flexibility and some guarantees. For somebody that might be retired, older homeowner, first of all, the guarantee that you have a property and the roof will be over your head, even if you can never make a payment on the property, cool. Flexibility in that maybe if you don't want to see the balance go up, like you got a reverse, but you're not excited about it, cool. Send in money when you got it. We can't ever tell you any different. The other thing here, you got some cash in the bank, right? So we see these transactions happen all the time. We do them all the time. And what do we see? We see homeowners who were not wanting to sell. When the agent first started helping them, not a very friendly situation. To after they've moved, and sometimes they've moved places where they didn't want to move to. From a transaction I did not too long ago, $1.5 million house in LA, Sherman Oaks, to a $450,000 house in Menifee. Didn't think they would ever want to do that. They did it. They're there. They have money in the bank. They have an optional payment. They're happy as can be. As it turns out, the burden of trying to keep up something was bigger than the burden of worrying about not being in that place after all. See it all the time. And I want you guys to understand that that happens. Not every time. I suppose there's some time when someone moves from LA to, I don't know, Palm Desert, and they're like, man, I would rather be back in LA. And then again, I can't afford it, so I'll just be unhappy anywhere. Doesn't happen all the time, but you get my drift. you hear it all after a few years. But the point is, it's still there available for them, right? All right. This is a typical downsizing transaction. See them all the time. Super helpful for clients. Give them a way to live their life for a long time without having to worry about money. Big deal. Now, let's touch upon something that is an extra part of this loan. And again, these loans do not come with instructions. And a lot of things I'm teaching you guys today, I had to figure out. Because as a loan officer, you can do these loans and not know a thing about them. And guess what? 13 years ago, when I started doing reverses, I didn't know a thing about them. And I started doing these loans, giving people something. I had no idea what I was doing. Well, fortunately, 13 years taught me a lot of the idiosyncrasies and also some benefits that don't come in a manual. I don't have to take a test. I had to learn it through actually helping people do it. And this is one of those things. When you have a reverse purchase that you're going to do, and let's take this example exactly here. You see that the client retained $145,000, and what are they going to do? Probably put that in the bank. And at the same time, they now have their property, right? And they don't have to make a payment, so change their lives. There is a way actually, though, to use this loan to get more money back based on future equity increases, future appreciation. Sounds weird, right? I know. FHA built this into their loans. By the way, private industry, they won't do what I'm about to show you because it scares them. But FHA is willing to do this. This is called an overfunding amortization schedule that we have made. This is our custom things that we do. Let's look at that prior example where the client had $400,000 and they were buying a $500,000 house. Same situation. Remember before how they're going to have $145,000 in the bank? Well, we're going to do something a little different here. I'm going to say to that same client, look, I know that I asked you to put down $255,000 before, and that would leave you $145,000 in the bank. I want you to put down all $400,000 on a $500,000 home. In other words, leave no money in the bank. Why would I want to do that, Ryan? I don't have to make a payment on this house. I'll have no money in the bank. It'll be locked up in the house. You better have a darn good reason why I'd want to do this. And I'll say, of course I do. I don't want to look like a knucklehead. I got a great reason. Here's the first reason I want to tell you, which is maybe not that exciting of a reason for the individual that is going to own the home, but maybe the heirs. And that is, like any loan, if you bought a house and you borrowed $400,000, you're going to have a lot of interest. If you borrowed a house and only bought a house, and only borrowed $100,000, that would be a very inexpensive loan, very low interest. The problem is most people don't want to lock up money in a house. So with the reverse, when you put down $400,000 and you only borrow $100,000, guess what? Low interest. If you don't make payments on the house, your interest will stack up very slowly. If you want to make a payment, a very small payment. So in other words, what I'm helping people do here is to make this loan very efficient by putting more money down so that they'll have a lot more equity in the future. Maybe that's for them if they decide to sell the house, or maybe they really want to pass on something to the next generation. And so this is a way to do it. But then the next question is always this: well, Ryan, what happens if something goes wrong? I've given you all $400,000. I now have $0 in the bank. Even though I don't have to make a payment, and that helps, I got no money in the bank. I'd say, here's where the reverse kicks in. That's very cool. That extra money you put down, right? In this case, it's $145,000. Because the last slide, they put $145,000 in the bank. This slide, what we've done is we said that $145,000 extra you put down, you can get it back if you need it. So this is what we've done now. We've made a loan that's very efficient, but yet we haven't locked up that extra money. You can ask for it back. You can get it back even if the house depreciates. You can get it back in the middle of a depression. You can get it back. All you got to do, send in the request. A week later, you got a check or the wire in your account. So what you're essentially doing, instead of just leaving money sitting in a checking account, not really doing much, you're saving a bunch of money, but you're not locking it up. So that's the first benefit, which I love, because I love to deliver reverse loans that are cheaper than anybody ever thought they could be. But here's the next benefit. The government says, look, here's what we're going to do. You've put down the extra $145,000, and, in the back of our minds, we know that a house appreciates. Now, we could say it's every 7 years, every 10 years, whatever it is, but ultimately they do appreciate. And FHA, in their wisdom, of course, said, well, a house will appreciate, and the house isn't ours. It's the client. Everything still belongs to the client. So if that house is appreciating, it's only right that appreciation is theirs. So we can break them off some of that appreciation, and we'll do it incrementally. Since we don't know when the house will appreciate or not appreciate, we'll just kind of make it more of a linear thing. Let's take a look here. When you put down the $145,000 extra, if you look at year one, okay, on the chart, and follow that all the way over to where it says line of credit. You see where it says 152, 138? That's what your 145 turned into. So simply after 1 year, you've picked up $7,000. How about if you let it ride? After year two, guess what you got? Well, 145 minus 159, it's about $14,000. That's considerable. If you wanted to every year, after year two, you could just sweep that $15,000 off every year, year after year, and just pay your taxes with it, pay your insurance, do a little fixing up on the house. The point that I'm making here is that FHA, in their wisdom, said, listen, we don't mind giving people more money back out of the house than the extra they put down, because we know eventually it will appreciate, so our risk should stay low. And we're giving a benefit to our older homeowners on releasing more of that equity through this system. What is that growth based on, you might ask? It's based on the interest rate that you borrowed on the loan. So in this case, when this client got this loan, the interest rate would have been 4.315, plus the 0.5% in mortgage insurance means their total rate on this loan is 4.815. So not only is that maybe the interest they'd pay, or that is the interest they'd pay on the money they've borrowed, but that's the interest that will get paid on the line of credit. So even if the houses were in a recession or the housing market's going down, their line of credit will still grow because the interest on the loan is still there. So the property value could be going down, down, down. Their available proceeds on the line of credit go up, up, up. So what we have here is when we understand how to use this tool properly, this loan can be totally different from two people that might have the same exact house, the same age, the same value. If they understand how to use the loan differently, one client might end up with a $400,000 line of credit and a $100,000 balance, and the other client might end up with a $400,000 balance and no line of credit. So the trick is, obviously, of course, to know about it and understand when you have the ability to use it the best way you can. And this is the stuff we've just been checking out and learning over the last 13, 14 years. My partner and I, Rob, we just constantly are looking at these loans and trying to figure out how to squeeze every dime we can out of it for a client, because we want the purchase clients ultimately to have such a great experience that they can start telling people. And hopefully you guys as agents, this will help a referral situation. When these things are performing like they are, they can't help but to tell their neighbors and their friends, they got this purchase loan, it's got this line of credit growing, the interest isn't really adding on, that all these cool things start happening. Whereas the other way, if they just borrowed the maximum they could and put that 145 in the bank, like the first example, they probably would have spent that 145 and then had a big balance going up, and what? They might still like the situation, but it's not nearly as powerful as this way. Okay, any questions on this? And by the way, one more thing. Sorry, Crystal. I don't want you guys to memorize this, try to maybe even understand where I'm getting these numbers from. My point of this slide and the previous slides are to know that you can do these loans in a different way than maybe you'd ever heard of. You can do it safely. We can deliver something a client's never experienced before. I don't expect you guys to sit down and do these numbers for them. That's my job. My job is to make the magic happen. You guys just need to know that the magic is possible. Okay, questions?
Great. So Connie asked, assuming that the owners are still in the home when they pass, who has a say in the sale of the home?
Connie, great question. We got a slide devoted just to that, so you got to hang on. We'll get to it though.
All right. Thank you, Ryan. So one person asked, what is the maximum LTV allowed?
So when you purchase or when you're refinancing, right, because it's the same product, our LTVs are based on age. So if you want to know what the maximum LTV is, or I would say the smallest down payment and the biggest loan amount, or if you're refinancing, what's the biggest loan amount, you'd have to go to the oldest bracket, which is in the 90s. And that's about 70 to 75% of the value of the property. When you're younger, you get a smaller loan amount. So when you're 62, that's running at about 50% right now. So if you're buying a house of the reverse and you're 62, very young, you're putting down about 50%. If you're up that upper bracket in the 90s, you might only be putting down 25%. So we are totally age-based. And if you guys wonder why that is, well, think about it. If I'm going to get a loan at 62 and I don't ever have to make a payment, you have to leave room in there, right, for interest to add on. So that way we don't get, we don't have all that equity beaten up real quick and the house ends up upside down, because I got a long life to live when I'm 62. Long life, right? We're talking almost 30 years for life expectancy. A 95-year-old, let's say, they have a shorter life expectancy. They might only miss 3 or 4 years of payments. And so FHA would say that's a very small risk that they miss 3 years of payments and the housing market crashes. We believe the house won't drop quickly. Not a lot of interest will add on. We can lend them a lot more money. That's why we talk about age in terms of LTV.
Okay, great. Now we have another question. So is the line of credit independent from the running balance of the mortgage if kept unpaid? Can the heirs draw that line of credit at the end if the person dies, or will it be applied to the deficit?
Okay, good question. So let's take a look at line 10 here on this amortization chart, everybody, guys and gals. Line 10, your balance is 177, and this is assuming you have made no payments for 10 years. It's 120 payments you've missed, and our balance has only gone to 177. Again, so much better when we put down extra money. And now the line of credit is 234, 457. So her question said something along the lines of, are they independent of each other? Well, they sure are. Even though they are both being grown by the same rate, how much is in each one, of course, is going to get different growth because even though the rate's the same, the balance is the same. If you pull money off the line of credit, you can put it in your bank. Let's say in year 10, you had 234 and you wanted to pull 50,000. That would mean your line of credit gets lowered to 184 and you put 50,000 then on the balance because now you've taken that. So your balance would be then 227. So that's how it works. Now, what happens if you make it with this loan all the way up to the point where you pass away and you never took that money off the line of credit? Now, the heirs don't get it, but remember, the thing is that since that property was never that money was never taken out of the property, the benefit to them is they have a very low loan amount that has to be paid off. So let's say in year 15, our clients passed away at 87 years old. Even though the heirs don't get the 298, after 15 years of never making a payment on a house, they only owe 226, and this house is probably worth 7, 8, 900,000. So the benefit to the heirs is that that money was never used, so interest never collected, which means the loan balance is super low, so they're going to get a lot of equity out of this house when it sells. So you see how the benefit works either way. Now, what I would say to a client, though, maybe if mom and dad or your uncle, whoever has this loan, is not doing well, and we're in a recession, right, or a depression, and that property value is really low, and that line of credit is really high, there might be a situation where you might say, hey, obviously you do this delicately, but you say, hey, Uncle John, or hey, Mom, you know, we should probably get that money off the line of credit because the house values are really bad right now. That line of credit is really big. Let's get it out and put it in the bank. And that makes sense. And so now, if they pass away, the heirs do have the line of credit money in the bank. And do they care what the value of the property is? Who cares? Walk away from it. You got all that money in your pocket, and the FHA's got to worry about if the house is upside down, not you. We'll talk more about that later.
Okay, great.
Okay.
I want to remind everyone out there, it's 10:55, so we got 5 more minutes until we're doing the first drawing for the $20 Amazon gift card. If you have not put in your name and your email in the chat yet, please do so right now if you want to enter that giveaway, which we'll do in about 5 minutes, which gives Ryan a bit more time to go through one more slide.
Yeah, let's see if we can get through 2 more, but you don't have to downsize user reverse. I know we talk about that a lot because that's a majority of the situations, but sometimes someone might need to buy a more expensive home. Hey, we can do that too. Remember, for us, it's all about the age and therefore your down payment. Let's say a client sells a 450 house, and I'm gonna go through this quickly, and they have 310,000 after you sold their house cash. They got their eye on something for 600,000. At 72 years old, buying a $600,000 home, you got to put down 310. We'll give you 290. Now what you've done, you've bought a more expensive home. You've gotten rid of a mortgage payment. So you've increased purchase power with the reverse. Okay, so you can buy more expensive. Let's hit this last slide before we do our giveaway. Couple things. Even though I say I can do a reverse purchase or a reverse refinance when maybe you can't get any other loan, I don't want you to think that that's easy. These loans can be tedious, which means I need time to get someone qualified. So I always recommend on purchase loans, I pre-underwrite. We're a manually underwritten industry. We don't have DU. We don't have automated machines. We got to manually underwrite these things, which means it takes a little bit of time. So we want to pre-underwrite, get them approved before you talk about them selling their house or anything like that. Well, maybe you're talking about it, but before you put the house on the market, that way we know we're not going to have a homeless retired person. We never want to end up in that situation. I have gotten calls from other mortgage companies where things went wrong. They didn't pre-underwrite. So we'll give you what we call just a pre-qual, which means you're making sure the numbers, like the down payments and whatnot. But to give you something that is more of like a pre-approval, it should take 2 weeks. We can't turn these things around in a few days, okay? All right. The client has to go through reverse mortgage counseling. Why? Well, the government wants to make sure they understand how the loan works. Of course, we do our job in educating, but the government doesn't know what kind of job we're doing. Maybe we're doing a crappy job. Maybe we don't know what we're talking about. Well, that's not the case with us, but it's nice when a client can hear it twice anyways. So before they can actually, we can pull a case number or do an appraisal, they have to have their reverse mortgage counseling done. I give them a list. They call. They do it over the phone. They should be doing this with pre-underwriting. That way we're not messing up our timeframes. If we pre-underwrite and handle things properly, we can close reverse purchase loans in 30 days like any other loan. If a client is not counseled and it's not pre-underwritten, you can have a messy situation in your hands, 60, 90 days, because in the thick of an escrow, trying to get stuff done, you need to be set up to win. You can't give any concessions. In other words, you can't credit closing costs as an agent. Likewise, the seller can't say, I'm going to give you $5,000 credit. Everyone's got to pay their own half of escrow, those types of things, just the standard things. Reach out to us. We'll tell you what it is. But it's just like a standard contract without any credits. This is in your forms. You need the escape clause and the mandatory clause sign. That's standard FHA stuff. You know, of course, we're probably already working with you guys once you have identified a client. But if you come across something and it's right in the middle and things are happening fast, I mean, you definitely want to send us an email and tell us what you got going on so we can identify any pitfalls or get things solved quickly or let you know what needs to be done so that you have a nice, clean transaction. So you guys can always reach out to us, of course, email. You can usually text Rob, my partner, or any of our loan officers direct, or email us, and we'll get back to you as quick as we can, especially if you're right in the middle of meeting with a client. Okay. So with that, Crystal, do you want to do a giveaway?
Yep, so let me go ahead and I'm gonna share my screen along with you just for a quick second. So let's see here. Do you see my screen, Ryan?
I don't, Crystal.
Okay.
Maybe do I have to stop?
No. I'm doing it where they should be simultaneously seeing the screen. Anyone in the chat, do you guys see my screen? Just let me know. Let's see here.
Yes,
See, I can't see the chat from here.
Looks like yes.
Okay.
People saying yes.
Okay, perfect. So I'm gonna go ahead. So I put everyone's names who's entered the giveaway with their full name and email. And now I'm going to draw. So we're gonna pick a random name. See, no. See, the winner is, Monica Tien. Congratulations, Monica. You are the winner of the first Amazon $20 gift card. So Monica will be contacting you after the class. Don't worry. We'll reach out to you and we'll send you that digital card. Now, if anyone wants to enter the 12 o'clock giveaway, please provide your name and email. If you already provided your name and email address, it's okay. You don't have to again, you'll automatically be rolled into the second giveaway. But if you want to put in your name for the second giveaway, please go ahead and put in your name and your email and we'll get you there. All right, Ryan, the floor is yours again.
How come we don't get to see you?
I'm sorry, what?
How come we don't get to see you? You're hiding from us.
I'm the admin.
So what? You're human. Okay. All right. Here we go. Let's run through briefly just some facts. In case you guys were wondering why reverses exist, why people do them, even sometimes when they've had that negative connotation with them. Well, it's because we have a lot of older homeowners, a lot of individuals that they may not have a whole lot of savings. In fact, about half our retired homeowners short on savings. So this is why the product has legs. This is why people sometimes do the product when they're not even sure. They haven't even gone through to understand what the product is. This is why a lot of homeowners are going to sell their homes even though they don't want to. This is where the business is for you and I. Hey, I am not you know, I'm not excited. Does it sound weird? I'm not excited that our company has to exist. I enjoy doing what I do, but I wish everybody had plenty of retirement savings. Nobody had to worry about this kind of stuff. When I first got in the industry, I didn't know that I wanted to be in the industry all that much because I was like, man, it's kind of a bummer, but it is the way it is. You guys are going to help them sell the house when they don't want to. We're going to help them get a loan that maybe they don't know much about, and it still will work out for them. Okay. So that's the important thing I want you to get out of all these figures. I'm not really going to spend that much time on. We have just shortages of incomes when we're retired. So that's why the product happens. One thing that happened big, I mean, they took away pension plans basically. The company said, look, all these big corporations said pensions are too expensive. And as the CEO, I get paid more when I get the share price up. The share price is sure going to go up if we have to keep on kicking these pension plans out. Heck, you guys know if you worked at Sears back in the 70s, just selling tools, you got a pension plan. That sounds like a great job to me. If I could get a pension plan at Sears selling tools right now, I don't know. It sounds like fun. And I get a nice pension plan. Guess what? Not anymore. So this is really, we had a paradigm shift happening 70s and 80s where my grandparents and my parents might have had access to, more my grandparents. My grandpa had a pension plan, solid. My mom, no, she's a boomer. They switched it up on her. There we go. There's one thing though that does help out, especially if you live in Southern California, anywhere in California for that matter, is that we have equity. We have a lot of equity in these homes. That equity is gonna, for a lot of people, be converted into a way that will help them bridge that gap in money they don't have. That might be in reverse refinance. That might mean selling their house cash and buying something cash, smaller. Might be doing selling and buying with the reverse. There's all kinds of different ways that people are going to do it. But the point is, we're going to see a lot of equity coming out of homes to help bridge the shortage in retirement. A lot of older homeowners, guess where they live? California is the #1 destination still for retired homeowners. So you guys are in the hot zone, the red state, whatever you want to say. This has nothing to do with politics, by the way. This is the hot zone where retired homeowners want to live. And by the way, where a lot of that equity is, you guys are in the equity business, so am I, in a roundabout way. We're helping people get equity out of their homes by selling, by doing loans so they can bridge the gap. You guys are basically turning into a financial person as well. You always were, but now more so than ever. This all seems to start kicking off when people hit their 70s. If you wanted to know, those boomers just started hitting their 70s, and that's a huge demographic of homeowners. So what happens is in their 70s, that's when things start to get to the point where you're like, man, I'm tight on cash. I got a lot of equity. I guess I'm going to make the decision. We say this is the average age of HECM or FHA reverse mortgage borrowers. The big piece of that pie is 70 to 79 years old. Well, I'm going to tell you, since we turned down so many older homeowners to refinance the reverse, what this chart tells us also is that this is the age when you will see listings being created, even when people don't want to list, because that's when they finally have said, how I'm going to make this work in retirement. People are working to their late 60s now. A lot of them retire in their late 60s, and then when they hit their 70s, they start really having to answer those questions that they didn't want to have to, which is, this is going to be tight. I got to do something. I got to do something I don't want to do. I want you guys to be there for that moment, and we're going to help you get there. We're almost there. We're almost how you're going to be the one to be sitting at that dining room table to help them with this transaction. We'll all be back at those dining room tables if you guys aren't already. And that is an incredible seat to be in, especially with the retired homeowner that doesn't want to hop on the internet. They don't want to do that kind of stuff. Listen, I'm in my 40s. My natural inclination is still to want to talk to somebody, get a referral, somebody I can touch. Like, I use the internet for some things. I'll buy something online that can be mailed and shipped to me. When it comes to big decisions, I don't want to have somebody mailed in a package, and I don't want to do that. So anyways, this is a great demographic to be still that face-to-face emotional type thing that they want to know you and like you. All right, so we had a lot of questions on if you have the reverse purchase loan, if somebody bought a house, the reverse, one of your clients, or you guys are going to more and more be running into heirs or homeowners who already have reverses and they have a lot of questions. And that's an opportunity for you guys to make sure that you can provide the information for them and then hopefully be that trusted agent that gets the listing when maybe the borrowers pass away or even when they want to sell the house. This is important stuff. We get a lot of stuff on this. So when somebody has bought a house or they refinanced the house with the reverse, let's say that they've passed away at this point in time, right? And the heirs now are saying, what the heck do? We have this house with the reverse on it. Well, the first thing you got to check out is how much is owed. So therefore, I can see if there's equity. Remember, this is basically a loan with optional payments. So you look to see how much is owed on their statement. You figure out the value of the house. Hey, you have equity. Heirs, if you want that equity out of there, we'll just sell the house and handle it basically like a normal sale at that point in time. The other situation, which is when a house is underwater, we'll go through that in a second. So over here, heirs, hey, by the way, if you don't want to sell the house, the only thing that the investor, the bank, whoever has the note on the house is entitled to is whatever is owed. They don't care what the house is worth, just like a regular loan. Hey, give us the money that we lent them, and the house, obviously, your house is paid off. The other situation, they're selling the house, they're taking and pocketing it. So this above water situation, much like when somebody passes away with a regular loan, just got to either refinance it or sell the house, and that unlocks it. By the way, with the reverse, though, the heirs are going to get up to 12 months to do this. So it gives them some time. It doesn't happen automatically, by the way. When the last borrower has passed away, it's very important that those heirs get in touch with the servicing company, because the servicing company figures out that the borrowers have passed away, and if they don't hear from anybody, they assume the house is vacant, and they're like, man, we got to do something here. We're owed money on a house that's empty. So they can't just take the house, right? It's not theirs. There's a loan on the property. So if they don't hear from anybody, they just have to start what? They got to put it into default, which means that if they don't hear from anybody in 90 days, the house will go to auction. So it's handled much like a house with a regular loan. If no payments were made and the lender didn't hear from anybody, they would start foreclosing so they can get their money. Same thing at the reverse. With the reverse, though, the heirs can get in touch as long as, by the way, we'll talk about in a second, as long as they're, the beneficiary or the trustee or they're on title, they can get in touch with the servicer and go, hey, we're here and we want to try to figure this out. And the servicer will say, okay, good. Somebody's there taking care of the house, which means we don't have to start foreclosing. And as long as they remain in touch with us, we'll give them up to 12 months to get the house sold because we know that somebody's there looking after the thing, right? Now, in order for the servicer to be able to talk to them, we want to make sure, as with any home, that if the house shouldn't just be held in the name of the borrowers, because that's a probate situation, right? And if there's nobody else on title and the borrowers were the only people on title and they passed away, that's probate. And the lender, and then the heirs try to call the lender, and the lender's like, we don't know you from Tom. Sure, you're the kids, but that doesn't mean that you automatically get the right to the property. You got to go through probate. And you don't want to be in a probate with the reverse. It's just messy. So if you do run across somebody and their parents have a reverse, you could do them a huge service and be a value added and go, hey, by the way, do you know if your mom and dad or your aunt and uncle, whoever, are just on title, or do they have the house in a trust? Oh, no, they don't have a trust. You'll be like, oh my gosh, you don't want that to happen. So you should probably either have the servicer, call the servicer and say, can we put somebody on title with us? By the way, I'm not doing an estate planning class. I'm just trying to keep people out of probate, or get that into a trust, okay? So that way, when those borrowers pass away, if you got somebody on title, the house held in trust, now the servicer will talk to you and give you that 12 months, okay? Little side note there. All right, let's go back to our example. Now let's say that the clients have lived there a long time, never made any mortgage payments. Maybe we're in a down housing market and the house is upside down. and the heirs are like, uh-oh, maybe we wanted that house, and now the house is upside down. That means if we want the house, we have to give them $400,000 when the house is only worth $300,000. That sounds like that just doesn't sound exciting. So fortunately, in the case of FHA reverse, FHA says this, look, you want this house, and one of the good things is you've been paying mortgage insurance, or that mortgage insurance has been part of this loan. So to the lender, FHA is saying, look, if the heirs want this house, we as FHA are going to pay the shortage so the heirs don't. So this is like, we call it the 95% rule, which basically, if the house is upside down and the heirs want it, the lender, whoever's servicing the loan, will say, okay, get an appraisal done. Oh, the house is worth 300. What's 95% of 300? 285. Heirs, just get us 285. Refinance it. Get us 285. Give us cash, and we'll come off title. The house is yours. Even though what's actually owed to them is 400. Well, you know who makes that up? I know you guys are all saying it right now. FHA. FHA kicks in that extra 115, settles the bill. The heirs have gotten the house. They didn't have to pay the upside down portion. They actually got a little bit of a discount, right? They got 5% off market value. Kind of cool. 95% rule. Maybe the heirs are like, we don't even want the house. We don't care. Okay, well then go get all the stuff you want out of the house, and then you don't have to call anybody. Because eventually, of course, what's going to happen? The servicer is going to figure out that somebody's passed away. They're going to send out the default letters, right? Saying, hey, is anybody there? If nobody responds to them, then what? They're going to move it to sale. It'll go to the courthouse auctions. They'll be put up for sale, and they'll get their money back, or whatever they're short, FHA again, going to cover the bill for them. You don't have to. Hopefully it turns into this. You know, we really don't want the house that whoever, aunt and uncle or mom and dad had. We don't care. But I guess we don't want to let it go into foreclosure. I mean, that's kind of crappy for the neighbors. And, of course, our buddy's a realtor. So let's get that thing short sold. That way realtors can get it sold. They can make the commission, and maybe they'll take me out to a really nice dinner. They remember me at Christmas time, right? So what we can see here, everybody, is that the government, the lenders, nobody wants this house. Nobody's trying to make money, profit from something other than just interest, like regular loans. And they're going to give the heirs a year to get it figured out. So it's important, though, when you guys run across somebody and you find out that maybe their parents, or even they're the ones at the reverse, are you the only ones on title? Save them the trouble. And then make sure that they know that you're very familiar with handling the sale of reverse houses, so that way you get that business coming up. How are we doing on time? Let's see if we got time for any questions. I could grab a couple questions. Crystal, if there's any questions, maybe one or two?
Actually, we have one question from Monica. She asked, who is the servicing company, FHA?
No. So there's multiple servicing companies, and sometimes even the government takes over on servicing at a certain point in the loan. So they're very off-the-wall servicing companies. A company called like C-Link or Champion or RMF or RFS or they're just weird names that you never heard of, and they end up servicing the loan. All right. Let's run through some things that we hear, which aren't necessarily correct. They're out there anyways. Hey, the government or the bank, do they own the home? Of course not. Do they own your home with a regular loan? No. You secured a deed of trust. In other words, you borrowed money on the home, and they're simply on title as the lender. Will heirs lose future appreciation? Whatever appreciation is in that home, or whatever equity is in that home, when borrowers have passed away, hey, that gets passed to the heirs, just like a regular loan. Lenders and the government aren't trying to take any equity or anything like that. They're just simply a loan. Can the heirs inherit the home after they pass away? We just went through that. Most certainly. It's not our decision to let anybody inherit it. You got to be in the trust or be on title or go through probate. We don't control that. But If you guys want to inherit the house, make sure those things happen. We don't have any control over that. We don't say who gets the house. If you happen to be set up properly and the heirs want to keep the house, just pay off the loan balance. That's it. Investors, the government just wants to see the loan paid off. This is the one we went through before. Somebody lives in a house for 30 years and they never make a mortgage payment. And that house is upside down. Bad real estate market. Remember, that's the deal that's in this with these loans. They're saying, look, we're making a deal with you. You don't have to make any payments, and we'll never ask you to leave as long as you follow the rules that we're going to go through on the next slide. As long as you follow the rules on the next slide, you don't have to leave, no matter what the position of the loan versus the value is. You stay there. Here's how we mess up reverse mortgages. Happens. Number one, got to be owner occupied. Don't get a reverse and then rent the entire house out. Now, where this can get a little sticky is, what if, let's say you had two borrowers. If one passes away, well, the other borrower gets to live there till they pass away. What if that last borrower, though, needs to go into a nursing home? What if they get hospitalized? Well, there's always that possibility. So what FHA said is that you can leave the place for 12 months to get care. After 12 months, you need to do something different. Here's your options. After 12 months, get your butt back to the house. You should do it before the 12 months is up, by the way. Get back to the property. Get released. Show us that you haven't been gone a year. And then once you have established that you're there, they'll let you go back again for another 12 months. You can be gone from a house with a reverse mortgage for 5 years. You just can't do it every single year in a row. So it can't be consecutive years. Cumulatively, you could live there, be gone for 5 years. You got to make it back. So that's how that works. This is a biggie. Pay property taxes, insurance, etc. A lot of properties go into foreclosure because the homeowners stop paying their property taxes. A lot of them are older. Maybe they run out of money. Maybe they don't realize they haven't paid it. Something is going on. And then what? Well, if you don't pay your property taxes on any house that has a loan on it, eventually a foreclosure is coming. We just are going to be on top of it a little sooner, because like some regular lenders pay the taxes for you. In cases like that, I have seen reverse services do it, but it's not going to go on for a long time. So a sure way to get foreclosed on a house with the reverse is not to pay the tax insurance. You will be foreclosed on in the HOA as well. So when you hear about maybe high foreclosure rates in our loan industry, a lot of it is because of this, which, by the way, regular loans foreclose on older homeowners too. It's just that they don't have the data to know which how many of the foreclosures happening in regular loans or older homeowners, because what? Well, they don't discriminate on regular loans when they do age. We have to have borrowers above 62. So we know older homeowners are getting foreclosed on. But I would suspect a lot of older homeowners with regular loans end up in foreclosure because they don't pay their property taxes as well. So that's another way to get foreclosed on with the reverse, is not paying those things. One more brief note on this is that we have curbed a lot of our foreclosures in our industry. When it comes to property taxes, how did we do that? Because about 6 years ago, 5 years ago, we started finally asking people if they have enough money to pay their taxes. I mean, imagine that. Like 8 years ago, you could get a reverse, and I didn't ask if you had $1 of income. Nothing. You could get a reverse and not even have enough to pay your property taxes. Well, if you got a reverse and used all the money and you didn't save any and you didn't have enough money to pay your property taxes, you're probably going to get behind in taxes. So what we do now to help out with that and to stop that foreclosure rate from going up is, that's why I want to know, hey, here's how I qualify you. You got enough money to pay your tax insurance, you got enough money to eat, and you got enough money to keep the lights on. Those are the basic things I'm checking, and I have formulas for that, and it's not a whole lot. It's pretty easy to qualify with income, but at least we're checking, because it was foolish to give people loans and not even know that they could afford to pay the taxes. Probably not a great thing to do for the last 25 years of these loans. Well, we fixed that. You got to maintain the home to FHA standards. What does that mean? That's a pretty long list on FHA's website. I mean, obviously it's not that strict. You've probably seen some homes that have FHA loans that are in bad shape. We're looking for mostly health and safety issues. Are there broken windows in the house? Are the shingles flying off? And we don't check, as a matter of fact, either. We have to get a complaint. The servicer has to get a complaint, or they have to hear some way or another the house is not meeting the standards, and then they will send somebody out to see. So people ask, well, Ryan, what are these standards? I say, well, it's basically this. When you got your loan, we did an FHA appraisal. That appraisal said it met FHA standards, otherwise we couldn't do the loan. So basically keep the house in the shape it was when you got the loan, and you will be meeting those standards. Otherwise, we don't check. We don't go out and do an annual check on the house. We just assume everything is fine unless some way we find out differently. And then you got to cure the problem, right? So these are the three ways, basically, the people are getting foreclosed on. They're leaving the houses for longer than a year. They're not paying their tax and insurance. Maybe the house is in really bad shape. In my 13 years, I don't have one borrower that's ever called and said, Ryan, I got a letter that said my house didn't meet standards anymore. So it'd have to be pretty bad. I don't hear about it happening very often. But I do see this, and sometimes we see this. It's always traced back to one of those three things. Any questions?
Yeah, we do have a few questions.
Okay.
Dorothy asked, do you have a table of maximum LTV by age?
Well, we have a calculator that's right here for you that you can put on your phone that has the charts built in. The reason that we do have these charts, but they're very long and they change depending on interest rate, and every age has a different percentage along with a different interest rate, et cetera. And so we don't even use them on a daily basis here in our office. We use machines to calculate it for us. And you have access to this as soon as I show you about how to use it.
Okay, great. And then one final question from Nina. She asked, how will they know if occupant is not in home if caretaker or children are paying?
Yeah. Okay, so the first method that they have is they send an annual occupancy cert in the mail. And the homeowner should be answering it and saying, I'm still here, everything's cool. They sign it and basically saying, you know, I'm okay and you don't have to worry. So if that letter does not come back, that's their first clue that they need to worry about what's going on. They have other ways of checking, ways that, of course, we're not privy to, because what they don't want to do is give us a recipe to help people get reverse mortgages and not live in the house. So they keep some things close to their vest, but I can tell you, first and foremost, the letter is the big deal. So there might be other things, like maybe a change of address from one state to another. That might be a red flag. Maybe somebody has, you know, so there's just ways that they might look. Maybe you change your address with the Social Security Administration. I don't know. I'm just throwing stuff out there because, again, they don't teach us, and I don't teach, you know, everybody else how to try to avoid it. If you return that occupancy cert, you should be in good shape. That's the most important thing. Okay, let's run through our calculator, right? Because I think it was Dorothy that asked the question, Ryan, can we get a chart on this thing? I'd rather not do that to you. It's long, it's ugly, and it changes. So you might have one, and then next week, FHA makes a change and you don't realize it, and then you're looking at the wrong thing. So you're better off to use this tool that we made for you guys. This is a calculator for calculating down payments, or to put it another way, this will tell you how much of a loan somebody will get based on their age. You go to your Google Play Store for you users who have maybe Samsung phones or have the Android operating system. Go to your Google Play Store, type in REV4PUR, you will find it. Of course, iPhone users, you're going to your App Store at this point in time. I don't know if there's any other phones out there, maybe there are, but we are only on Android and Apple iStore at this point in time. Is it an iStore? I don't know. It sounds weird. Anyways, you download it, you put the buyer's ages in there, you put the purchase price, and boom, it'll tell you the down payment and it will tell you the loan amount. Well, guess what? If you just kind of want to know what you might get for a refinance if you're doing it, use the same calculator. Just don't look at the down payment, look at the loan amount, and that'll tell you basically what loan amount you could get on a reverse based on not the purchase price, but it's actually the value that you're putting in, okay? These are estimates. If you're looking at it and you're like, wow, I need, 10,000 more or something like that, just text us because we have the calculator set up to be a little conservative. So if you really want to know the exact dollar amount and you want more than just a general idea, email us and we will give you the exact figure. By the way, this calculator also is only for the FHA. So if you have a house, it's probably worth, I'd say, $900,000, or they're buying a house more than $900,000. You got to email us to get those figures for the private products, because this one is only tuned up for the FHA product. But in general, any house is probably 900 at this point in time, I'd say, and below, you'd probably want to use the FHA product anyways. All right. This is a big deal. Hey, married couples. We used to let reverse mortgages get done, and we didn't allow anybody under 62 to go on the loan. So that was a problem, because people would say, well, we want to reverse, or we want to buy with the reverse, and we have a spouse under 62, so we're just not going to put them on the loan or on title or on the purchase contract. And the problem with that is, even though you get your loan, when the person who was on the loan passes away, the other spouse, guess what? They're not on the loan. So they either got to refinance or sell. That wasn't working out too well. So years and years ago, maybe about 5 or 6 years ago, so 2015, maybe 2013, 7 years ago, we said, look, we will no longer let you leave a younger spouse off, because we don't want to be responsible for letting you, unfortunately, maybe cause a problem years down the road and have a spouse not be able to stay in the house when the older one passes away. So we will now let one spouse over 62 has to be over 62, and the other married person can be, I don't know, as young as they want to be. But if you're 62 and you married a 40-year-old, well, guess what? We got to think about that 40-year-old not making payments until they pass away, which could be 50 years. So you're going to get a much smaller loan amount if your spouse is a lot younger. Okay? This is for FHA loans only. Again, the private products, they want both parties over 62. They don't do this rule. But the government saw a need. I mean, sometimes you got a 58-year-old spouse and a 62-year-old. That's all over the place. You don't want to not be able to get a loan for 4 years difference. So the government said, we'll now do that. We're just going to give you a little less money because they're a little younger. This was a big deal. By the way, this is one other way. If somebody had the old school loan and they didn't put their spouse on, that is a way that somebody can get foreclosed on, because maybe they were never put on the loan because they were too young. Those cases are around here or there. But of course, we can't do that anymore. We won't do that anymore. We didn't want to have to worry about throwing widowers out of homes. It's not a very good marketing plan for our industry, I'll tell you that much. Unmarried borrowers, hey, listen, if you want to go on the loan, I don't know, with anybody, your neighbor, your friend, sister, whatever you can think of, cool. But you all have to be over 62 if you all want to be on that loan. That under 62 rule, only for married people. Here's where the private industry said we should probably have our own reverse product. See, the government says, look, as soon as a house is worth $765,000, $600,000 or more, we're not going to increase our loan amount. We don't want to be giving out $1 million reverse mortgages. We want to keep them, you know, more along the lines of the general housing prices. So you can buy a house for $2 million, but we're not going to give you any more money. We're going to assume that house was $765,000 and give you a $400,000 loan amount, right? Something like that. So that's where the private industry said, well, geez, we'll do loan amounts for $1 million, $2 million. And so even though you see $765,000, $600,000, just remember, usually if the house is about $900,000 or more, we go to the private. $900,000 value or less, the FHA loan still works really well. All right, so let's grab any more quick questions on this. I'm gonna get a drink of water. I'll be right back. If you guys got questions, get them up there and I'll answer them in a second.
All right, we don't have any questions right now, but guys, if you have any questions, please feel free to put them in the chat. I see a couple people have just joined in. Welcome. And don't forget, we have a Amazon gift card drawing for $20 at the end of this presentation at 12 o'clock. So if you had already entered the 11 o'clock giveaway, you don't need to provide your email address again, that's okay. But if you have not entered the 11 o'clock giveaway and you want to enter the 12 o'clock giveaway, please go ahead and put your name and your email into the Zoom chat, and I'll get you up in that random name picker, and you'll be there to possibly win that $20 Amazon gift card. So go ahead and do that. Meanwhile, let's turn it back over to Ryan, and right now he's going to show you guys how you can get these listings now.
Okay, so that's pretty much it for product knowledge. Thank you for sitting through that for an hour and a half. Hopefully it went quickly for you. We want to spend maybe the next 20 minutes or so just talking a little bit about what we've seen out there over the past years that have helped kick something over to be a listing, right? Help get more business just knowing about that reverse, okay? So the first thing that I know a lot of agents end up coming up with is somebody that they already know or somebody that's already in their sphere, okay? Because your ears should perk up a little more when you hear the talk about any kind of financial hardship or reverse or anything like that, because you know that there's an extra tool out there that maybe you weren't confident enough to talk about before. You didn't even know could do this. And I can tell you a few sales that we see listings get from agents come from illness of spouses, right? Because when a spouse falls ill, not only from an emotional standpoint is it difficult, but from a financial standpoint, it can also create a problem. So, if you guys aren't checking in with both your clients who still have parents that own a home or your older clients and just asking how the spouses are doing or how their health is, it's very important you guys do that, because that sometimes is the primer for a sale of a property, is the health of an individual, okay? Also, you guys are looking for clues such as, what kind of condition is the house in of the people that you know in your neighborhood, right? People that you talk to. Are they still driving that older car? Has the house not been paid in a few years? Okay. People aren't outright telling everybody that they're having tight on cash, but the signs are certainly there, especially when it comes to condition of homes, and that nobody wants their house to get, dilapidated, if you will. But it is a sign for you that they are having a hard time. So we got some tools that once you identify people who maybe the spouses are not doing well, you can see the houses aren't in good shape. You've even talked to, their kids just to see how they're doing. By the way, whenever you're talking to some of your clients and they still have parents, I hope you're asking just simple questions like, that's cool. How are your mom and dad holding title, right? We see so many houses where sometimes the kids don't really know that their parents are holding title outside of a trust, with just them on title. It's probate issues, right? Probate city, power of attorneys, those things are very important. So I just kind of want you guys, if you haven't gone through your book, to go through your book and start thinking about those questions for older homeowners, especially the health and knowing what kind of situation the house is in. What does the house look like? Because those are clues. What would you do with that information now once you know? Maybe you down and outright just don't want to call them and talk about selling their house, because maybe that's a touchy subject for them. Maybe they've said, I don't want to sell, and you've maybe had conversations with them already. But if you know that they are having some difficulties, maybe you could just send them a few things, right? Send them something that just talks about maybe what's on their mind, right? So one of the ways that we have helped you guys and want to help you guys do that is we developed a system with materials, right? Because having materials at your disposal is so important. You guys don't want to have to recreate what I've talked about for the last hour and a half. You certainly don't want to take the time to do it or have to think about it. So we've done some of that for you guys, and we've actually put it in a way to help you get it to them. Now, one of these ways that you guys can try out to see if you have a client, maybe you're thinking about this, is you can use this thing that we call GoCourt'em.com. And by the way, we'll get you guys logins for everything that I'm talking about right now. So this GoCourt'em is a tool, it's an automated database, if you will, where all you guys really need to do is identify that you have somebody who has met those parameters we talked about, and you can hop into this website of ours, fill out the form, you'll see what we have available, and then we'll send it to them. So what's in there? Information, not about like, hey, I want to list your house. That's not going to go very well, but information maybe they're thinking. So we have newsletters in here that will go out. So if you put their name and their address in here, like the first month, they're going to get a newsletter. What's that newsletter talk about? It might talk about like, did you know what's going on with Proposition 1690 that you can transfer tax space to a house? Did you know that you can buy a home, and even if you don't got great credit, a lot of income, you can buy a house with this type of mortgage and have an optional mortgage payment? If it also talks about that things about like cash buyers, right? Cash buyers can be very dangerous for older homeowners because they make it sound so great, but we know what? Cash buyers are probably buying these homes at 60 cents, 70 cents on the dollar, and they would get so much more money for a house if they talked to a professional. So we have an article in one of the newsletters that says, beware of cash buyers. So each newsletter that we'll send them 3 over the course of 6 months, and then a letter from you in between, is just going to be information that's geared towards somebody who's thinking, I might need to sell, but doesn't really want to tell anybody about it yet. And these articles in the newsletter do that for you, right? So you don't have to approach them. You can just send it to them. And then a letter will come after each newsletter the next month and go, hey, I just want to see if you got my newsletter. What'd you think about that article on being able to answer your tax space? What'd you think about that article on how people are liking living in senior communities? Just to get some conversation going with them, right? So we'll send that out and we put your name on it. So that way it's coming from you guys, right? Of course, our name is on it too, because we do loans, and legally we need to make sure we have our information on there. You guys can also, we'll get on our website and you guys can get those newsletter yourself and send them yourself, okay? So our thing here is that we want to make resources available to you guys, and we want you to not have to spend a lot of time thinking about putting stuff together. We have an automated system. That was the one I just showed you. Go quarter, we'll send them out. We'll do the first one for you, by the way. It costs us about a little more, about $15 to do a run for one of your clients. And we'll do one for you, just complimentary. And if it works and you want to do more, we can figure out something out after that. But you guys can just give that a try. Throw one of your clients in there. See if they like it. Get some feedback. We'd love to know the feedback on it, because at the end of the day, we want that to turn into a listing for you guys, because hopefully we can get a loan too. Now, let's say that you've run through people that you know. You threw somebody in that go quorum, or you didn't, but you're just like, all right, I'd like to find out where there's more people that might want to list that are outside of my sphere. Somebody new, I want some new blood to bring into my sphere, some new transactions. Well, we have 2 things that we can help you out on as well. So what we've always found interesting is the clients that we've helped do a loan for them to buy a house, what were their particular parameters? How could we match them so that we could find that next person, so you guys could find that next person? So we enlist other types of software. In addition to the software that we've made, we use other people's software as well. This one here is called Title Pro 24/7. What we're using this for is we want to help you guys to ascertain who in maybe your neighborhood might be the next person to sell their home. And if that's the case, then you guys could get that newsletter in front of them. Go on our website, download a door hanger, get something in front of them, because you have an idea that they might be the next person to sell, right? And if it's on your own street, heck, we want you to know. I don't want to ever hear a story about you guys not being the agent for a listing on your own street. Man, I know what that feels like. Sometimes I've not gotten a loan and it went somewhere else, and I'm like, why did that happen? What did I do wrong? How can I stop that from happening again? This hopefully will help you to stop that from happening again, at least with our demographic, right? So, Title Pro, this is what you do. You log on to Title Pro. We say, look, let's pick my area. How about my own neighborhood, right? I want to get an idea of somebody very close. That way it makes it very easy for me to figure out how to give them something or drop something for them, or maybe I know who they are already. So this Title Pro has all kinds of information on homeowners. I've heard it said that the people that get data, right? Like the Googles of the world and everybody that assembles data, supposedly they have at least 100 or more pieces of data on every homeowner. In other words, in a database somewhere, somebody knows 100 things about you and your house and the people living in your house, right? Kind of scary, is what it is. But this is nice because you know what this software does? It helps you to use data so that you know that person, according to the data, might be selling a home. This is how we do it. You're going to log into Title Pro. We're going to tell it the information that we want to know. What information do you want to know? We can help you with that. By the way, we have videos on it. All of these things I'm doing today, including the course I just went through, the softwares I'm showing you, we have broken apart like into 7 and 8 minute videos, and it's all on our website when you get the logins. So you don't have to try to memorize this stuff. Just find the video talks about Title Pro after the class if you want to do this and watch it. If you don't remember what happens when someone passes away with a reverse mortgage, find that video and watch it. Try to make it easy for you so that way you don't have to sit there and try to memorize all this stuff. It's way too much. Back to Title Pro. So you can watch our video and we'll tell you how to use Title Pro. Why? Because we want you to know if somebody on your street, what? Might be that next person to sell their house because they're tight on cash. Maybe they're older. So what would that say? If somebody's tight on cash, they're older, and you've visually been by the house and see that it needs some work, you have somebody who might be in financial distress. So wouldn't they love to get a couple newsletters about how people in financial distress can buy a house using a loan with optional payments? Maybe they'd like to know that they could take that $1,000 a year tax base with them. Maybe they like, so all of these things might speak to them, or you could even go knock on the door, introduce you. Depending on how you like to get clients, at least you know with this software, it might help you decide how to hone in on the particular people so you don't spend time on people who are not going to sell, right? Like maybe somebody who just bought a home 2 years ago, they got a family, they got a 4-bedroom house, and they got 2 kids, and they just bought the house. They're probably not going to sell. Somebody who's barely making their mortgage payment, looks like the house needs work and they're struggling. That's who we see selling, and you need to get them the right information. Title Pro does that. Watch our video on it. We'll get you logins too, by the way, so that way you can log into the system and use it. If you want to watch one of our Remind videos, we have fun with this stuff too. By the way, some of our videos are us actually using the software and going and knocking on the doors of the people that we pull out of it. We want you guys to see that listen, we're in this with you guys. We want you guys to know that we're constantly testing and trying to find ways that you guys can find individuals. By the way, if you go back to this Title Pro, you'll see one of the videos that we did was cool, and that we can find out who's in default on their taxes with this software. So what we did is we went and looked for people who didn't have a lot of cash flow, had a mortgage payment, and were in default on their taxes. What does that mean? Yeah, something's going to happen. If it's a sale, make sure you're there for it. You can do that with software, and we did a video where we did that, and we found somebody who looked like they were going to have to do something. That could have been, and then we knocked on 3 doors to get that lead. Pretty good. Okay, Remind is something that is part of your MLS already, okay? And this is a software that, again, helps you to try to predict who's going to sell the house. Now, unlike the Title Pro, which is software before where you have to put in the data, Remind does it automatically for you. You log in, you draw a circle around where you live or your office is. You tell it, I want to know has a high sell score, which means who's probably going to sell their house, and boom, it tells it to you. So we have a little video on that, and then on the video we show you how it helps with older homeowners. Because remember, we're geared towards the older homeowners, but a lot of these softwares we're showing you, the Title Pro on the last slide and this one, you could use it for all kinds of homeowners. All right, so at the end of the day, I think what we really wanted to deliver for you guys is just the message that this reverse mortgage thing is not just the loan that people get to get money out of their house and not have a mortgage payment. That is a long ways away. Maybe that was 1992 when that was the case. In 2020, this thing is as much a tool to help you guys enhance your business and pick out some listings, to have the ability to be able to talk to clients who we know, a lot of people have seen the commercials and they're intrigued about this, but they don't want to call those. They know what happens when they call those TV commercials. They're going to get sold and chased forever. They would love to talk to somebody who they can already know maybe, and you guys can have some information on it. Remember this. If anybody asks you, how does that reverse mortgage thing work? I want you guys to always go back to this. Very simple. Reverse mortgages, they're a lot like a regular loan, but the mortgage payment is optional every month. And then when they say, well, how does that work? And say, well, it's pretty simple. If you make a payment on it, you've made a payment on it. If you pay what's showing on the slip, like a regular mortgage, you've made a payment, it's not a reverse. But if you decide to pay less or not pay what's due for that month, then it'll just add on to what you owe, and you owe a little bit more than you did before. And then you can decide next month if you want to do the same thing or something different. So it's really just a loan with optional payments, and that's it. You can get cash out like a regular loan, or you could buy a house with it like regular loans. You guys just remember that simple thing. You should always be able to kind of speak as though you're very not only knowledgeable, but you're resourceful. And that will answer most reverse mortgage questions, believe it or not. So with just that little bit, I want you guys to then make it into higher up on their list as a valued person, right? All right. The other things that we talked about after the reverse, right, are really just, I want you guys to try to have some fun with what we do. Hop on our website, shoot us a text, try that Go Courtum website, send out some newsletters. The first round is on us. You can download those if you want on your own from our website. You can download marketing materials. You can download all kind of stuff just to have fun with, I just want this to enhance your business again. I don't want necessarily to say you guys need to go out and make this a marketing plan. Enhance what you're already doing so you don't miss out on the older homeowner that this might actually turn into a deal. Okay, enough said on that. Questions and Crystal, what do we got?
Okay, so we got a couple questions, but before we go to the questions, we're at the end of our presentation. We'll reserve the last 10 minutes for Q&A, and then we'll do the drawing at 12. Again, if you'd like to enter the drawing, please go ahead and put your name and your email. But now that we've talked about all of these complimentary agent resources that you'll receive, what you'll also be getting is you'll be getting those logins. So there's 2 sets of logins that we'll provide for you. The first set of login is for our website, thereverseeducators.com. That's where you'll be able to access Go Courtum and our marketing materials. You'll be able to also see all of our videos and our tutorials that we made. And also you'll be able to access the course refresher. So again, like Brian has said, this is a lot of information in the span of 2 hours. That's why we provided the course refresher for you guys, where you'll be able to review all of the information that we've talked about and in even more detail. And you'll also be able to download the PowerPoint and other course materials in PDF form. So that is the reverseeducators.com, and it will send you your logins to you via email. The second login that you'll receive is for the Software Title Pro 24/7. That's where you'll be able to find those older homeowners that are right in your farm. And in order to receive both of these logins, we'll need to send that to an email address. So even if you don't want to enter the Amazon giveaway, if you want to just receive these information to help your business grow, please go ahead and leave your name and your email in the chat, and we'll enter you in anyway. But more importantly, we're going to set you guys up for success, get you guys the resources that we talked about. and go from there. So that's my spiel. Now let's go to the questions, and we have 8 more minutes to answer questions. So if you guys have questions, please feel free to.
I see a few that we've missed, Crystal. So let me jump a few here. Dorothy asked, will this qualify as reverse mortgage counseling? No. I wish, but it's got to be done by a HUD-approved reverse mortgage counseling company. And I would give somebody a list if they want to get counseled to do that. And there is a fee for that. Generally runs anywhere between $125 to $150 to get reverse mortgage counsel. I see Priscilla said, I thought there was another option of doing a deed in lieu. Well, while that may be an option, I don't know that the beneficiaries would even want to take the time to do that because they're not obligated to do anything. They could certainly call the servicer and ask, but then the question would arise, do the beneficiaries have a right to do a deed in lieu? So that kind of brings all kinds of questions. I think the whole idea with that slide was just to let everybody know the beneficiaries can keep the property if they want to and what they have to do to keep it, or if they don't want to, they don't have to do anything. So the deed in lieu would be starting to get a little bit more advanced, and there would be more questions that would be asked in regards to that. But thank you for asking. All right, let's see here. What else did I miss here? Oh, I think it looks like I got all the questions. Did we miss any questions by anybody that I missed?
No, I already double checked. You didn't miss
Okay,
any.
cool. Well, I appreciate everybody hanging in there. You guys, any questions at all? Any clients have anything? Hey, get a hold of my cell phone. It's on our cards. It might be somewhere. And text me. I can't say I can get back to you right away, but if you're with a client and they ask that question, you got a shot at it. I try to return text and emails as quick as we can. Sometimes phone calls take a little bit longer. So you might not get a call back maybe we try to call back same day, but it could be 24 hours. But quick question on a text, yeah, I'll try to knock those out right away. And if you want to figure out or develop some more business using those tools we talked about, and you've looked at the videos and you still want some more assistance, reach out to us. You want me to go with you on an appointment? Love to. You want me to go knock on the door for you? I just think this is fun. And at the end of the day, if we can have fun with this thing, you guys are going to see business come from this. And we want to be there, of course, to support and help you all the way, because we do know this. This is one stat I forgot to mention. If you got one time before I blow your mind out, 55% of the homes being sold right now are by people 54 and older, or it might be reversed. 54% is 55 and older. It's close enough to where we have a lot of those older homeowners. Guess what? They're listing homes and selling. So you guys got to get there and have some pertinent information that will be different than what the next agent is saying. Buying a house with a loan that has optional payments, that always triggers somebody to go, what is that? Yeah, be that agent that says that to them. Kick it off. And then if you don't know what to say after that, go, yeah, I got this guy. He'll help you out with that. Shoot over to me, and I want to try to turn that thing into a deal somehow for everybody, right? That's just little things here or there. Throw a little stuff out in there. Have some fun with it. It's gonna, it's gonna cause conversations. All right. I see lots of thank yous, and I got lots of your welcomes. I'm really glad that you guys spent time with me. By the way, we do this class in person usually at Arcadia, and we will be back at Arcadia shortly doing a live class. Come on down. We usually feed you. So the only thing I can feed you today is information. But if you come to our live class, I'll put a sandwich in front of you, and then we'll have some fun too. So we will see you guys there. We got 5 minutes left. I went really quickly today. I apologize. My cell phone number, no. That number, oh, by the way, I'm glad you asked, Dorothy. We do have a company line that's like texting and whatnot that we use to communicate with you guys. And sometimes you guys think that's my personal. Crystal, do you want to throw my personal cell phone number in there? So if they have any questions they need to get answered right away, they can text me.
Yeah, I can go ahead and do that.
So you can text that other number, you guys, where you got the invite, But just know that goes into more of a pool where Crystal, myself, and Robert, my partner, we all kind of watch over that. So it might not be as quick on the response. You get my cell phone that Crystal just put in there, I'll get your response usually quicker than that. And, well, sometimes it's 11 o'clock at night and I'm sitting on the couch watching TV. You got a question that I can answer, yeah, I'm happy to fire it back. Why not? That, you know, I shouldn't be watching TV. Maybe I should be sleeping, but I'll be happy to answer your text, okay? All right. I guess we're going to sign off, you guys, and reach out to us. We're in the city of Orange. We go everywhere. We travel from San Diego to LA. I sound like a Johnny Cash song, you know. I've been everywhere, man. So we'll get to you guys, or come see us.
All right, well, let's go ahead and do the last Amazon giveaway. So let me share my screen really quick. All right, so it says here that I am screen sharing. So here's all the names that we have. And let's go ahead and pick a random name. All right, let's see who is the winner here. The winner is Dorothy Arietta. So
All right, Dorothy. Your
yeah.
participation came back around to you.
Right.
Cool. Cool,
So,
cool.
congratulations, Dorothy. Again, we'll be emailing the winners separately, and we'll be including your digital Amazon gift card certificate in that email. So look out for that. Otherwise, look out for our correspondence. We will be following up with everyone to make sure that you all get your logins, and so you can start earning more listings.
All right, everybody, have a great day, and I hope to hear from everybody soon. Bye for now.
Bye for now.